What effects could central banks have on the global market climate? Well, joining me to find out is Brian Lawson from IHS Markit. Well, Brian, it's been a busy week in the market. So taking a look at the global bond markets, what's to say that they're overheating?
There are multiple indicators of what the European Securities and Markets Authority describes as excessive risk-taking currently within the capital markets. To start with, we have a range of relatively difficult emerging market credits coming to market, new issues which are being extremely strongly received. Examples of that in the recent past being Tajikistan with a debut bond issue, Belarus and Iraq on a standalone basis having had US support for a number of prior issues. And there's a long list of similarly troubled or complex emerging market risks which are currently tapping the market. If we look at the high yield sector in Europe, by the end of August, the total volume of new issues had been almost as large as the full year volume for 2016. We're also seeing a steady tightening of spreads in the riskier asset classes in the market. Examples here being that the EMBI plus emerging markets index is now some 12.5% tighter in spread against US Treasuries during the course of 2017, and that more than balances out for increases in US interest rates. And we're also seeing that in the high yield market. Further examples of risk appetite and sizable risk being taken in the markets are the very long durations being achieved on a range emerging market and other issues. And examples just this week included 30-year issuance by Bahrain, also a 100-year bond issue by Austria, again setting its tone of people going down to the very long end of the curve in search of yield. And as a last example of, again, this hunger for yield driving people to take more risk, we have seen the highest volume of inflows to local currency emerging market bond funds since 2010.
Now, the ECB and the Federal Reserve are both moving closer to tighter monetary policy. Now, what impact could this have on the market climate?
In terms of policy making, we are looking at a change in the overall climate. We've had a long period of monetary easing in both the United States and Europe. The US acquired $4.5 trillion of assets through its quantitative easing program, and in turn, the European Central Bank is now close to 2 trillion euros of assets under its APP program. Basically, the US is now moving to the point where it's actually going to start running down that stock of assets which it's acquired. It's planning to announce in the September FOMC meeting that it will gradually allow its portfolio to mature. In the case of Europe, we're looking at quantitative easing continuing until at least halfway through 2018 and only then being tapered. And in both cases, we're absolutely clear that central banks will move very gradually, cautiously, and will give a lot of advance warning to what they're going to do. And in this context, we really don't see central bank policy as the main driver of a reversal in this current appetite for yield. Indeed, we've had 4 rate increases already in the United States, and yet the markets remain in rampantly good form. So it's quite clear it's not US policy or indeed European policy making that's going to necessarily turn around this risk favourable cycle as it stands at the moment.
So, Brian, what risks are causing concern at the moment, and how likely is a sharp market fall?
Basically, we have considerable concerns regarding market stability going forward, and these are not by any means unique to IHS Markit. Indeed, the ESMA risk dashboard published this week commented that risk in terms of market conditions, in terms of credit, and indeed markets as a whole, were all in the very high category, the highest level that ESMA has within its quarterly risk dashboard. So it's not certainly our view, it's actually a widely held view across the European regulatory community at this stage. And the concern that we have is not one about tomorrow morning or necessarily even in the course of the remainder of 2017, but unspecified period in the future in the event that a sudden shock risk event led to a large number of major fund managers and investors seeking to change their risk strategy at the same time. We would then have very severe risk in the markets of material imbalance, potentially leading to a sharp spike in yields. And we also have to remember that in Europe, that is exacerbated by the fact that a large portion of the yield curve is actually at negative yields at the present. So it has a lot further perhaps to go in terms of any correction in the event of adverse factors to regain stability. So what we're looking at is an unknown event in terms of timing, but one which could have quite serious consequences for funding for the corporate sector and indeed for governments and for financial stability overall. The riskier and longer life the investments that people make, the greater the capital losses will be in the event of such a shock.
Fantastic. Well, Brian, thank you for your insights. That's all from us. We'll be back on Monday with our week ahead, so stay tuned.